di ba? Yung mga nasa unahan po, lalaki po yung mga production ninyo. Ayan.
Hindi ka mag-MDR dito.
Ayan na. Sige, very good.
How's the food? Food's good?
Yeah. Very good.
Most important.
I was just telling them, Mark, that we have also guests coming from different parts of Metro Manila.
I realized
So
that.
we have all the way from it's like how many kilometers away from Metro Manila, Bicol? 300 plus kilometers.
Really, that far?
All the way, yes, from
Yeah,
Bicol.
that's Bicol.
Yeah. And then we have also from South Luzon, so it's not just Metro Manila advisors and agency leaders. So, yes, all the way from South Luzon. Kanina, no? Itong mga ating taga South Luzon. So this is also quite far from Metro Manila, but they decided to come here to meet up with you.
Great.
So I'm sure that there are a lot
Thank you. I
of
feel honoured.
things.
Thank you.
Yeah. Sige. So we'll be starting in a few minutes. There we go. Good afternoon. Good afternoon to our dear agency leaders and our advisors. Can I hear mo na warm round of applause? Welcome to this highly anticipated discussion on sustainable wealth creation. I am JB, I'm Jen Bakli. I'm sure that some of you doesn't know me yet. I'm a leader development principal, and I will be your host for this afternoon. I'm very thrilled to this. Dr. Mark Coney was during the pandemic, right?
Yes.
Yeah, I think maybe.
Can you hear me? Yes, excellent. Well, it's a great pleasure to be here. Thank you all for taking time today out of your busy schedule to come and have a chat. I think the question is, what has changed since I last spoke? I would say in some ways it's easier to ask the question, what hasn't changed? Because the world we're now navigating is entirely different from an investment and economic point of view. I think when we were in the depths of the global pandemic, the issue was whether or not the economy would be resilient enough to be able to withstand the pressure of the various lockdowns as they sort of transpired across the global economy. And through a mix of fiscal stimulus and policy and hardship, we survived. And similar experiences in different parts of the world, but very different policies that were put in place. You compare Europe to the US and Europe to most of Asia, very different policies. So that had a big impact on the way in which we've emerged economically from the pandemic. In many ways, a lot of the influences and trends we're now seeing would have occurred anyway. So the pandemic hasn't been a cause of many of these features, which I will go on and talk about, but it was an abrupt introduction of many of them, because it was, if you like, it was a breaking point, a hiatus in the way that the economies were functioning. And a lot of those long-term trends were sort of accelerated through. And as we emerge, we're now much more focused on what the world looks like going forward than we have been before. And the reason for that is, in that 20-year period leading up to 2021, we had become incredibly complacent. The absence of inflation, largely as a result of a huge amount of capacity, production and manufacturing capacity, coming into the global economic system, mostly from mainland China, after China entered WTO in 2000. With all that extra production capability and the influx of cheaper labor, meant that economies globally could continue to grow without worrying about pricing pressure. And we enjoyed that for 20 years. Unprecedented year-on-year growth at a global level with price stability. It was never going to last forever, because these things never do. But if you look at the early signs, and we started to see those evolve, and they were highly predictable over the last 10 years, because demographics are very predictable. You know where you are today, and you know where you'll be in 10 years in terms of the age structure within a population. And China had reached a point where the sustainability of the access to cheaper labor was starting to exhaust. And from an economic point of view, the need to move up the value chain in production and value added was already there. So this was coming to an end anyway. So that long period of low or no inflation in the global economy and excess capacity in the areas where people wanted to grow and spend was coming to an end. So that was number one. Number two, what we saw during the pandemic was when people were locked up, they could buy capital goods, they could buy tradable goods, they could spend money on things that could be delivered. They couldn't engage in services. You couldn't go to the cinema, you couldn't go to a concert, you couldn't meet with your insurance agent, right? You couldn't do all those things that are termed services in the economy, but you could spend money on goods. And what we saw was a major bottleneck appear as that supply was unprecedented, where people diverted their spending, their consumption spending, onto goods. We saw a big kicker on the demand side, which put a lot of inflationary pressure in the system. And that as we came out of COVID, that became a switch from goods to services. So what we've experienced since coming out of COVID is an acceleration in services costs and services prices. And at the same time, we've seen the cycle of commodities play out. So we saw a cut in commodity prices. Now we're seeing energy prices move up. We saw food prices in Europe and the US accelerate at the early stage coming out, and now we're seeing that starting to flow through this region. So all of these things have an impact. And a couple of conclusions. Conclusion number one is those days outside of China, which we can talk about separately, outside of China, those days of low inflation are now over. We will not go back to where we were. And that means our whole approach to thinking about investment needs to moderate and change, needs to adapt. Right? So that's number one. Consequence of that, number two, interest rates are higher.
Yeah.
And interest rates will stay higher for longer. So we know we're going to see the central bank in the US make their announcement over the next day. They'll probably keep rates on hold, but the wording will be cautionary because they want to manage inflation expectations. Number three, the money that was spent, particularly in the US and elsewhere, on supporting the economy during the lockdown has exacerbated the accumulation of public debt. And that public debt has consequences. So inflation is going to need to stay above trend levels for an extended period. Because when you keep inflation, or when inflation is above trend for an extended period, everybody pays the price. And the price is that we have to suffer increased costs. The benefit is that public debt becomes smaller because the inflation is deflating the debt. So although you're going to hear words about we're going to kill inflation, we're going to get inflation down, behind the scenes, they're going to tolerate higher inflation. And they're going to tolerate that for longer. So rates are going to stay higher for longer. So these are significant consequences of the run-up to the period during the pandemic, and it was exacerbated by events during the pandemic and thereafter. The fourth thing I'll mention in terms of where we are is that the major change in the structure of our economy is going to be around the way we generate electricity and energy, the way we store, and the way we transmit, and the way we consume energy. And this is a major change, structural change in the global economy. And this is going to affect all of us here, how we think about transport, how we think about using energy, the amount of money we need to spend out of our own pockets on energy. So our consumption behavior will change. But most importantly, from an investment point of view, given it's a structural change in the economy, there are going to be a lot of opportunities that come out of this. There's going to be a lot of innovation. There's going to be a lot of redirection of capital to support that innovation. And it means that the way we position portfolios take account of inflation, higher rates, but also innovation around energy. It means we need a different lens to think about how we allocate and how we manage investments going forward. So, you know, I've been in this business now for since 1987. I've been in Asia for 34 years. This, to me, is the most significant adjustment to the way in which the structure of the capital markets and the economies are going to operate. This is now a generational shift. This is a difference in the way that the assets are going to perform going forward. So the challenge from a professional investment point of view is, how do we get our services to our customers? Which basically means, how do we provide you with the support so that you can have the confidence to be able to position products and services appropriately and avoid what we've seen in the past, where investment-linked products and products linked to investments more generally are badly supported in the market because they're sold when markets are doing well, and then when markets sell off afterwards, that volatility creates uncertainty, it creates regret, and often the financial advisor is not in a position to be able to provide suitable information and advice. So as an organisation, as AIA thinks about this going forward, we've done a number of things, and we can talk about those. I'm sure Kelvin will go into the details, and I'll give you a little bit of the background of how we've gone about this. But in terms of the opening question, there is opportunity there. It needs careful thought. We need a long-term approach, but we also need to think hard about how we provide you with the support so that you can have confidence that the service that's being provided is going to withstand this transition in our economy, which is a result of things that have been going on for a while, but also a transition in the way we think about sustainable energy.
Thank you, Sir Mark. I think that's a history. This is my question to Sir Kelvin. Did we see more challenges or opportunities arising from the pandemic?
Okay, before I get into that question, I would do justice without properly introducing Mark all over again. We get to meet him virtually the last time, right? But not in person. And this is the first meeting after pandemic. We get to invite him to come over. And it's been a busy day for us. In the morning, we have the meeting with the press. These are people that write for the business press, Business World and business article. We invited some of them to join, to meet with Mark, so that they understand a little bit more about who we are, the brand and what we do, which is important, right? No amount of advertisement that we do can match those. So Mark and I spent some time with our press. We just came from a lunch with some of our VIP customers. And of course, it's a wonderful opportunity for us to share who we are. And of course, for us to thank our customer. My job is to say, you know, you have the best advisor in the world, the most hardworking advisor, please support them. The rest is not that important. So that's my job. But it's really good to be able to connect with our customer. And there are some customers who came in quite far. Typically, we have someone from your place, Biko, drove 12 hours. Oh, Biko. I said, since when you start driving? It's last 12 o'clock. Reach here 2 o'clock, 12 o'clock, lunch.
Hours late. Wow.
So, and we have TP from Biko, as mentioned by JB. And of course, they took that trouble, and today this is a very special group. These are the group of people that we have invited, and these are the top producers or top units and top managers for some of our best-selling funds, which is the global funds. So that's why we have them here. And for me, you know, to be able to also meet with everyone. So as the day goes by, it gets more casual and more relaxed because press is a little bit more tense, a little more careful, with words and all those things, right? But here is family. Family is always easy. We invite Mark because it's a rare opportunity for you to be able to get up close with him. In a small group, not in like 1,000 people, right? How do you connect? How do you interact? There's no way to interact. So it's a really small group of people, but these are people that we think are important so that we can share with you more insights about what we are doing. Now, Mark is someone very valued in the world of investment. I normally don't get to hear much of his investment thinking, but when I want to hear something around investment, I will just need to Google Dr. Mark Carney and interviews and all those. It will come out, and you will see all those interviews he invited into CNBC and CNN and some of these big business news. He's always there as the keynote speaker and someone who share investment thoughts. And of course, he should be. Do you know? Of course, you know. We are the world's largest life insurance company. That you know, right?
Yes.
Which is big in terms of market cap, right? We are the world's largest. By market cap, we are almost 1 trillion Hong Kong. Okay. But do you know our second largest business? Our largest business is life insurance, right? You know what's our second largest business? Investment. AIA have a total asset under management of 300 billion USD. And that's managed by Mark and his team of very professional investment experts. And he has about 400 of them all over the countries and of course in Hong Kong. To give you a perspective, 300 billion US is slightly shy away from Philippine GDP. So he's like Ministry of Finance. Manage that size of asset. So Mark is always thinking about global investment, not just investment, what is happening globally, mega trend, and also region, because we operate in 18 markets, including the Philippines. So he has his eyes, he talks to experts, he talks to fund houses, and everything around what's happening around the world. And we want him to be here to be able to share those thoughts with you. Now I know it's not Warren Buffett. Warren Buffett is like, you're going to pay 19 million, I just checked. US dollar 19 million just to have a close and intimate conversation over lunch or something. 19 million. Here you don't have to pay 90 million. But you need to produce 90 million. Because you are here today, right? Not all the advisors are here, right? You are here. So you owe me 90 million.
USD.
Special discount peso is okay. But do it this month. No, just kidding. But it's a rare opportunity for you to be able to hear from Mark some of his thinking. Of course, some of these thinkings are very high level. So if I were you, take note. I know you had a very full lunch. Promise me you don't snore. Okay, please don't snore. That's okay. But going back to JB question around the insurance industry post-pandemic, right? Now, post-pandemic, the insurance industry continued to be very robust. We continue to see high demand, especially in two areas in terms of high demand. Now, one is higher sum assured. More people are buying protection. Two, the protection is often in the health space. So things like CI is doing well, health space, and of course health insurance. And partly that's got to do with the during the pandemic and even now, we are paying a lot of claims. Lots of claims. We last year paid 4 billion in claims. Medica business that we acquired last year paid 8 billion of claims. And paying claims is something that we do, right? Because that's an obligation. We promise to pay, we pay, right? And I know claims often, it's a bad, when you have high claims, often it's challenging because you have this headwind. We are in the business of managing risk, right? But for us, we are okay because we see this just ups and down. It's not every year we have a pandemic, right? It's like 100 years we have a pandemic, and life insurance is all about managing risk. So we're okay in that, but one thing that we're seeing is there's higher awareness on life insurance. So that's number one. Number two is when there's a pandemic, especially after the pandemic, people know how is it like without jobs. How is it like to lose the financial security? So the appetite to save become bigger. More so when you have this high inflation. So people are looking for long-term savings vehicle. Of course, you can put the money in the bank, but the money in the bank is very low interest. That is why when we launch IA 10, 20 days I think. 20 days, right? Got Signature Plus is the top selling product now. I mean, it's a new product, right? It's like, I don't know, maybe 60%. Because people are looking for guarantee. I would say guarantee, but they're looking for certainty. Something that is more stable. They don't want this up and down, right? But we recognize, despite, so the demand for long-term saving is there. But I would say it's just in the space of guarantee, but there are also people looking for something that is higher return because they are faced with the challenge around high inflation, high interest rate. So therefore, some of these other VUL products, investment products, there's still demand for it. I would say totally gone. And that's why we're continuing to see our global fund continue to be best performing fund for us. It's doing much better than, say, local funds. But then again, we have recently launched the Peso Silver Stick Fund under the trust company. That's doing well, by the way. Fund performance, although it's a very short runway, I think it's about 1 year only. And then when we launched, we limit it to few products because we have to roll out the funds to be attachable to other products. But despite that few months, performance has been very good. If you look at our Peso Stewardship Fund. And this is because the Peso Stewardship Fund is managed by AIA Group Investment. One of the things that when we go, when we rebrand ourselves, remember we rebrand, right? We rebrand ourselves 2 years ago. We promised one thing, that because we rebranded, we are going to bring the best of AIA globally to Philippines. That's why some of the best-selling fund in AIA, we now seeing it here, like the global fund, like the local stewardship fund. It's only Philippines, but it's managed by the same team. And very soon, next month, hopefully finger crossed, everything okay, we're going to have the best AIA Singapore selling funds launched for AIA Philippines. That's why Tam is, Paras is here today, right? Are you here for that reason? Okay. Just making sure he's doing, he will do a good work there. So demand for long-term saving is there. Now whether it's something that is more certain or something that have prospect or higher return, we want to provide that optionality for our customer. So that's why I remain positive on the life insurance industry. It remains a sunrise industry, not sunset industry. So very good for everyone here. So you have many more years to serve AIA. Please continue to work hard.
Okay, so I'm sure that they want to know also, and how does AIA Investments approach apply to this now?
Thank you. Thanks, Kelvin, for those kind words. Current status of the market, I would say that we're in transition, that there's a lot of uncertainty. You could label it, according to the popular press, geopolitical risk, inflation risk, economic uncertainty, however you want to label it. The visibility that investors have got now compared to the previous 20 plus years is much diminished. And hence, markets are sort of searching for direction. You're not getting rewarded for taking additional risk. And the easiest way to observe that is if you look at the credit spreads on corporate bonds. So when you buy a corporate bond, typically the market is demanding a slightly higher yield compared to government yields because you're taking additional risk. When the government issues debt, for most governments, excluding maybe Argentina and one or two others, they typically pay back their debt, right? But when you come to a company, back in 2000, the average life of a company in the United States was around 16 or 17 years. Today, that number is below half the number of years. Right? So the outlook, business model needs to change quite quickly. The advent of artificial intelligence, I've already mentioned the changing circumstances of how energy is going to be produced and stored and distributed and consumed. What we value highly 10 years ago is different to what we value highly today, and it will continue to evolve. So the lack of certainty is very much there, and as a result, you're not getting rewarded for taking that incremental risk. So if you think about where we are with respect to inflation and interest rates, the name of the game now is to be sensible. Don't try and take too much risk and get reasonable returns, short term. Longer term, as I mentioned, there's a lot of opportunity. The question is how you capture it, and having a long-term orientation is very important. We manage on our balance sheet, as Kelvin mentioned, about $300 billion US. And we've been building up key relationships with the world's best fund managers for decades. And the reason why we're able to do that is because of our size. Those companies that are very specialized are willing to work with us at scale, on an exclusive basis often, and at a fee level that you can't access otherwise. And what we did when we put together the global stewardship funds was to approach 4 of our key partners and to negotiate very good terms that would bring value to our policyholders and that would complement each other across the different skills that these different 4 managers are capable of delivering for the group. Now, historically, they've done it to us as an institutional investor. And we talk directly with the fund managers who are running the money, not with the wholesaler who's offering the funds. And what we've done with that program is bring those skills together, those capabilities, and combine them and deliver them to the front end of our business. So ordinarily, you don't see the group chief investment officer talking to our agents and our advisors. Normally, I'm a million miles away in a dark room full of screens and with spreadsheets and all sorts of analytical tools. You wouldn't normally see me. But since I've been in this industry now, as I say, well over 35 years, and since I've been in Asia since '89, I've always had the vision or the passion to address the need which is there, which is to give, firstly, our agents and advisors the confidence to represent an investment-linked product in a way which gives them the ability to be forthright and to offer a service rather than sell just a product. Because there are very few financial services companies who are truly high touch. Right? The scale that you need to achieve in order to make the economics work means that it's one financial advisor to hundreds of customers. There's no way they can deliver the type of high-touch service that is required. So how do you solve that problem? So firstly, you get a very high-quality capability, and you bring it together under stewardship where you've got professional fund managers taking the long-term decisions. If I buy a fund today, it's a great fund, but in 6 months' time, when inflation changes and rates change and the investment outlook looks different, as an individual or as an agent, as an advisor, what do you do about that? There's no way you know how to then bring a new fund in, or to change the weight, or to give the ongoing advice in order to maintain the exposure and deliver the long-term outcome. And that's the problem that we've addressed when we bring together all these different capabilities under stewardship and deliver it in a cost-effective way. So this has been a passion and a vision I've had, and this is why the design for me is so important, and this is why the world is changing and we need to take account of that. So if you think about, give you an example, if you think about buying an index fund, which invests in the stock market index, that index is reflective of history. It's not looking forward, because the companies that are in the index on the Philippine Stock Exchange today, they're represented in their market capitalization weights by size of company. And how does a company get big? It's because of the track record of that company carrying it forward. So now it's a strong representation in the index. But it tells you nothing about the future. And the future is unknown, uncertain, uncharted. And if we're correct in that we're going into a period of a fundamental change in the structure of the economy, you need to be forward-looking and not backward-looking. And that is where we engage with our fund management companies. And when we do our due diligence on them, we understand how they operate, how they nurture their talent, how they plan for the future, how they think about succession, and how they bring in the skills to be forward-looking. They bring in the engineers, they bring in the AI experts, they bring in the healthcare specialists who understand the future trends. And these are the relationships we build into the program. So although it sounds like we're going through a difficult period in the markets, a lot of uncertainty, I actually believe this is the future process is now starting to reveal itself. And I think there will be a lot of opportunity. We need to invest long term to overcome the sort of ravages of inflation. We need to make sure that we make decisions that we can stand by and feel confident about. Because if you're not confident, when things go against what you thought would happen, and they will do over the short term, if you're not confident, you suffer regret. If you suffer regret, you tend to sell at the bottom. Sorry, sell at the bottom when the value is already drained. You don't reallocate according to the opportunity, and you don't build up that long-term profile. So the program that we put together is designed specifically to address those issues. We're continuing to build in the infrastructure so that you get better information, so you are informed, so that you look good in front of your customers and clients. You have to, because they look to you for the guidance and for the confidence. So we need to give you what you need in order to be able to give them the right information, the appropriate information. And you need to be confident that behind the scenes, we're doing the best that we can do to support you and your customer. And critically, no other financial services company in this region, with our reach, has gone out and worked with partners in this way. All other financial services companies want to manage the money themselves because they want to capture the value for themselves and charge the fees for themselves. Our principle is totally different. Of course we get paid, but our principle is to bring the best of what's available directly to you through this arrangement. The product which Kelvin's talking about here is in response to talking to advisors and customers, where confronted with uncertainty and the need for income that keeps pace with inflation, we are working with a smaller number of those global partners to have a multiple income fund which sources that income from multiple sources and provides consistent performance over time. So you'll see in the market there are products out there, investment funds, which use the capital to pay out the income, right? So effectively what you're doing is converting capital into income partially. So if the income environment gets more difficult, or you've taken too much risk and you've lost capital value, you can sell down some of your positions and pay it out as income. So that is not the principle here. Our principle is to give you a stable NAV to maintain the value of your investments, but also to maximize within the risk parameters the income generating capacity so that we can continue to pay out competitively on a quarterly basis. The key here is the sustainability, and I think Kelvin can talk a little bit more, Colin can talk a little bit more about that. But in terms of the outlook for the market, I think we're going to continue to see headwinds. We're going to continue to see lots of uncertainty. There are parts of the capital structure where you won't get rewarded for taking risk. So you need to be nimble, you need to be flexible, you need to position long term. You need to be mindful of these risks, but I think the opportunity is there to capture the innovation that inevitably will start to unfold. One thing you may want to look up, I mean, you're probably not close to it, but one of the major initiatives underway in the US is called the Inflation Reduction Act. It's not an Inflation Reduction Act. It was the name they used politically to get the funding through. But basically, it's a package of tax incentives to bring the very best of the world's technology companies to the United States and set up their production in the United States to address critical issues, including climate change and sustainable energy initiatives. This is a major, major, major $2 trillion initiative, funded 50% by the US government. So this is going to have huge implications for corporate activity. And you need to think global if you want to capture that.
Hesitant, especially here in the Philippines. And so if I'm an advisor right now, if I want to convince my high net worth client to also get a portion from their savings from their CASA, current account, savings account, how do I do that? Maybe you have some insights, Sir Kelvin. Is that a good question, guys?
Yes. So it's an important question,
Yeah.
and I'm happy to share some thoughts around this. There is no one product that fits all customers, because every customer is different, and therefore AIA has always believed we first need to understand the customer, and we feel that there is no better person to understand the customer than you. You have personal relationship with the customer, you know the customer, you know what's the customer dreams and goals. And from then on, then you do, as you were taught, to understand it more systematically, professionally, by doing the fact finds, right? You do the fact find, the need base, and therefore understanding the customer, and then think, okay, given the customer profile, in terms of risk appetite, and in terms of the dreams of what the customer wants to do eventually, right? So then you think about, okay, you know, what can I then advise the customer? And of course, AIA, for us, we want to be in position to give you the optionality, A, B, C, D, E. Some customer would probably need just one. Some customer will need a combination of few things, starting with protection, right? First, provide the protection. And whether it's a protection around health, like the CI, or the accidental, or life, or retirement, or saving for education, or some medical insurance. So that's the first layer, and then we go to the second and third layer. And ultimately, when it comes to investment or saving and investment, AIA is in position. We want to be in position to offer the customer an option, and we've simplified it using the stewardship concept as described by Mark. And the stewardship concept is a concept that you know it, you know, three categories: adventure, balance, conservative. That's for the customer, right? Based on the risk profile. And then we ask the question, does the customer wants to have the investment abroad? That is the Global Stewardship Fund. Or the customer want to do Philippines? Because some customer wants Philippines, because Philippines have a very strong structural growth story. Young population, up and coming. I think I read somewhere it's going to be one of the top 50 economies by year so and so. Demographically is a positive. So there are people who want a long-term growth investing in the Philippines, but there are customers who want global. Or maybe there are customers who want both. Possible, right? Some diversification and some local. But what AIA should be positioned to offer you is, okay, global, local. And both are run under the stewardship concept. As Mark said, AIA work with for the global fund, we work with 4 fund houses, not like 40. When you work with 40, nothing work. 40, just 4, we work on with them, and because we have the scale, we can leverage the scale to do many things. Now, but the new demand, as we see, is people looking for not just long-term saving vehicle and investment vehicle, but they're looking for, okay, other than that, I want the, they want the income generation fund on a routine basis. It can be half a year, quarter, or whatever. But in our case, we selected quarter. Now, all of you sell A+. A+ in the Philippines work wonderfully. The endowment, every 2 years, we pay 1 endowment dividend. The concept of Pamana. Pamana is legacy.
Yes.
Yeah,
Legacy.
Pamana, where a parent buy for the children or buy for the grandchildren, where the grandchildren will receive that dividend or that coupon.
Yes.
That is love. Love from the parents, love from the grandparents. And it will keep paying, reminding the recipient, this is the love coming from the parent and grandparent, which is a wonderful concept from Mana. And the income fund, as we described, is also another form of Pamana. You know, that constantly pay out that dividend and remind the beneficiary, oh, this is coming from grandma, coming from the parent. It's a love. And some of this emotional thing can be executed through some of this plan that we are now in position to offer. One of the things, as I've said, I always turn to Mark, say, Mark, what is the best thing AI investment has to offer? We want it in the Philippines, do we? And we want it in the Philippines, and often Mark and the team have to think hard about, okay, how do we make the asset more hardworking, the various options, so that we can better serve our customer. So we're always thinking about a range of options for our customer, and so that we can provide yield, so that we can then think about what works for the customer. There's no one product that can serve everything. And just one more picked up from Mark's conversation earlier, sharing earlier. Now, AI investment is careful and conservative because we think long term. Sustainability is important. And sometimes the way we do funds offering, it cannot be looking good short term, but it's going to be disastrous long term. Because each and every one of you, your reputation and your trust with the customer stakes on what you offer, right? Many of them are your friends or family members. We know that, so we have to be very careful. Best be more careful, more conservative than be overly aggressive and promise heaven and earth.
Yeah.
And you know what? At the end of the day, who ends up holding the bucket is you, right? So we are careful about some of this investment. We are not going to be able to go out there and promise, let's say, 8% dividend payout or something like that. And how we do it? Of course we can do it. We just take from the capital, right? But so we do it more conservatively because we know it matters long term. So product design, fund design, those are very important as we consider the whole package. But we have an advantage because of our skill that we can leverage directly with the fund houses, and we want to pass the benefit directly to the customer. That's where we are coming from. So all this sounds good news for you. I
Yes,
hope.
yes, definitely.
But it certainly is not going to work now going forward. So long-term investing is more a broader philosophy. That we have to recognize that if you want to trade in the short term, you have to be very good at it. Because, and most of us have cognitive bias. Most of us have behavioral bias. And we get very emotional as we respond to events. And most of us are not very good at trading investments. We might think that we are good at it, and if you speak to someone who says they're good at it, they will always remember their winners, but they seldom remember what went wrong. In fact, they don't measure it correctly. Right? So long-term investing, firstly, is a philosophical approach. It's a recognition that for the foundation of anyone's long-term financial needs, the foundation of it is not going to be satisfied by making short-term bets or positions. The foundation needs to be well established so that it gives you the confidence that at least if the world changes in a way which you hadn't expected, at least the foundation of your financial plan is going to deliver a certain outcome and give you then peace of mind and confidence to take risks differently with everything else. So if I know that the foundation is well set, then I can think differently about the short term. And maybe you can put some money in the bank deposit or in time deposit, take advantage of high short-term rates, or maybe I can take more risk on individual stocks that I like or companies that I favor, or I can be more speculative. But I can only do that if I know that the foundation is well set. So these programs, which are aimed at long-term outcomes, are designed to do that for your customer, for your client. They're designed to build a foundation. They're not designed to be everything. They're not designed to have all the answers, but they're designed to make sure that the foundation of the financial plan is professionally managed, has the world's best fund managers on it, that has a long-term orientation. What does that mean? It means that we understand the broad trends, we understand inflation, we understand where rates are, we understand how different sectors are going to perform. And we position these strategies in a way which takes advantage of those themes long term. It also means that as circumstances change, we, as stewards of this stewardship program, we change the weights in those strategies to take account of where we are in the cycle. So when growth is doing really well, the equity content goes up, the weighting in those different strategies adjusts to give you more of a growth orientation. When we're in a different part of the cycle and there's no reward for growth or less reward, then we move the allocation a little bit so that we take advantage of managers who work better under these circumstances. So if you take a cross-section over time, the weightings have changed quite a lot, but it's still a long-term strategy. It's still aimed at getting those different themes in the portfolio. So that's what we mean by long-term, because if you look at individual investor behavior, and this is uniform, culturally it works across all markets. People tend to get sucked in once the market has gone up. They buy towards the top, they hold on for too long, they watch it drift down, they don't like losing money, and they give up all hope when the market's at the bottom. Right? This is typically what happens. And if they trade short term, it's a repeat and repeat and repeat. And the only people getting rich out of that are the brokers. We've all seen The Wolf of Wall Street, right? That's exactly correct. The brokers get rich on fees, the fund manager gets paid anyway, but the customer is left with underperformance. So the idea of these programs is to take that away from your clients, give them reassurance on the foundation of their financial plan, so they can rely on. That will be, long term, it will do its job, because we've got the best experts in place to deliver, who understand the market, and then they can be a little bit more opportunistic on the remainder of their program. So whether that's 50% or 40% or 60%, it really depends, as Kelvin says, on individual, risk needs and financial objectives. But get the foundation right, because that's the principle of good investing. If you're confident with your foundation, then your risk taking can be a little bit different. And it's the same if you think about insurance and you see the evolution of insurance. Satisfying your protection needs is fundamental, because if you as an individual are still worried about those types of issues that you haven't bought protection for, you're not going to take the appropriate amount of risk on your investments, because you're constantly worried about the basic needs, right? The protection needs. If you satisfy those protection needs, then with your incremental capital, you can do something a little bit more sophisticated and a little bit more interesting. That's how you get the maximum out of your financial net worth. That's how you make your money work for you. And that's the way that it's designed, as humans, as economic beings. This is how we operate. We try and control the risk where we can, and then we try and price the risk where we can't control it, so that we get value added from taking risk. And these programs that work with the world's best fund managers at the right price are designed to help you fulfill the foundational needs of your customers. That's what we mean by long-term investing.
Yes, thank you so much. Sir.
So it's not something that one person can do. We have over 400 people working in investments at AIA. It's the largest group of any financial services company in this part of the world. We have the largest sector team looking at credit. We have the largest team looking specifically at parts of the market of alternative investments. By that we mean private assets. We are a very significant investor at a global level. If you look at the last 12 months, the amount of money that was allocated globally to private credit, which is loans and various structured loans, the amount that was allocated to private equity, the amount that was allocated to real estate funds. AIA has been one of the largest allocators globally. So that means more than anything you can imagine. CalPERS, CalSTRS, the Singapore government, the Hong Kong government, MetLife, New York Life, you name it. We are considered to be one of the largest allocators to these asset classes. And what we do constantly, and there are two sides of the balance sheet. There's the liability side and the asset side. What we do constantly is develop new models and new technologies which get more precision into how we do that. So we get to profile the liabilities in a deeper and more sophisticated way. And we build asset programs which match those liabilities more closely. And along the way, what the regulator does is try and guide you as an industry to match those liabilities more closely. And it's a difficult balance, because in some parts of the world, the regulator reacts to bad practice and becomes over-enthusiastic about regulatory changes, and forces the insurer, instead of trying to match the liabilities, what they do is they force the insurer to stop writing those liabilities and issuing those products, because they make it so difficult, because they overreact to a situation. So what we do is we take a leadership role, and we work with our regulators across the different markets, the 18 markets, plus our home regulator in Hong Kong. And we have a constructive process where we explain how we're thinking about our products and our liabilities, and how we're matching those with assets in the market, where we think the risks are, and we optimize the assets with the liabilities. We've been doing this for over 100 years. And despite all the turmoil and volatility and all the uncertainty, Chinese property developers, Ukraine war, Russian debt, you name it, if you look at our portfolio on the balance sheet, in terms of how we think about risk and where we're matching those liabilities, We've been extremely conservative. I think that was the point Kelvin was making. So even if you're holding bonds when interest rates are going up and the value is coming down, it's matched to the liabilities, because as interest rates go up, the future value of our commitments actually comes down as well. So it's not the fact that the assets are falling in price, it's that they're matched to where the liabilities are going. And that's what gives you the confidence that the financial backing of this company is very, very strong. And we constantly have internal governance which forces us to examine how well we're doing. So every month I sit down with Garth Jones, the CFO, with Jane Plunkett, the head of risk, with Jens Young, the CEO, and a number of my finance colleagues and investment colleagues. And we go through all the key funds, which explains over 80% of our balance sheet, including the Philippines. And we make sure that the asset profile and the performance is consistent with the long-term outcome. And that's the precision and dedication and sophistication that we are known as. It's our hallmark, AIA. When we do something, we do it with resources and we do it properly. We don't cut corners. We think about what is the right thing to do and what is going to be seen to be the right thing to do. So we expect, every day we make a decision, I expect my team of 400 colleagues, that decision becomes public. I will be very comfortable that every decision, if it were to appear on the front page of the newspaper tomorrow, I will be very comfortable with how that decision was made. And that's the quality of the company that you are working with. That's what gives you the confidence when you're out there in front of your customer. And I'm extremely proud. You know, I often say, I've been in this business for well over 35 years. Every single day that I have learned on my job, the experience that I've gained, every single day in my job now, I apply everything I've ever learned on a daily basis. It's been a 35-year apprenticeship to get to this point, and it's the same for all of my colleagues. And not a day goes by where I don't utilize or access that knowledge that I've gained over that period of time. And investments, it's a job of apprenticeship. It's not something you learn at school. Because when you get out into the real world and the markets confront you, that's where you learn. And you learn from people who have experience ahead of you, and they pass on that learning. So when we sit down twice a year with the Exco and we talk about where is succession in this organization, who is going to do your job in 5 years' time and that person's job in 10 years' time, that's the commitment that we have to building the legacy in this company, to make sure that those VULs or whatever else it is, you know, whatever's held on the balance sheet is going to last through time. We've got that level of commitment. And it's interesting, when we look at the fund management companies that we work with, we expect the same attitude. And many of those fund management companies we work with are actually partnerships. And they spend much of their time talking about the next generation of talent and how to invest. A bit like when you build an agency, right? How you build an agency and build the culture and the capability and the commitment. The same goes into building a fund management company. And that's the quality that we expect. You look at someone like Capital Group or Wellington. These are companies that have been doing it for 50, 75 years. It's a partnership. Each generation of partners hands over the keys to the next generation. This is the world we live in. We'd like to think that all of this could be replaced by artificial intelligence. It cannot. Artificial intelligence is a series of models that takes past experience and uses those models to extrapolate forward. Very useful for data mining, very useful for picking out trends, but completely useless if the world changes. There you need human judgment. So the models help you process and they give you better insights, but you need human judgment. So that's a sort of commitment. That's how we can be confident. When it comes to the unit-linked products, it's a different story. Because there, the variability of the markets is owned by your customer. So our commitment to you and to your customer at that point is to make sure you've got access to the world's best. And that we're not taking shortcuts or over-promising, to Kelvin's point. or putting in place structures which will work for a limited period, but afterwards you're on your own. That's our commitment, and it is a different product, and it is a different sales process, and it is a different service that you provide to your customer in that environment, because they are open to the variability of the market. But I do believe that this is an important area for growth, because increasingly your customer base are going to want access to these types of services. The question is, can you deliver the service to the same high standards? And our commitment to you is that we will work with the best in the market, provide the oversight and the stewardship to make sure that the quality is worthy of having AIA's name on that service and on that product. That's the way we think. Because we know how difficult your job is, because we're customers as well. We face the same challenges as individuals.
I just can't help but ask, going back to one of the things you mentioned earlier, about eventually brokers and fund managers getting paid anyways for underperformance. The stock management fees. It's observed globally that management fees has fallen, except for Asia, which is actually viewed as predatory in a way. So if we're talking AIA, do we have a commitment as far as our customer base as to managing our management fees? I think it's related to James' question, because we have investment horizons that are tied to a particular date.
Yes.
And people will always argue that it's not timing the market, but we sell insurance every day anyways. So if there are in a calendar year 260 investable days, and all of those management fees are getting deducted like clockwork, and those are the main pain points that we encounter with our clients. How is AIA different? That is locally and globally, and do we have a commitment to bring down management fees?
Great question. Our business is a high-touch business, and bringing professional capabilities into a retail context, which is basically what we're talking about, is an extremely expensive business. We often, as an investor, my job and my colleague's job is to go out and find the most efficient companies, and companies which are able to get costs down and to deploy capital and deploy human capital in a very productive way. Do you know what sector in our economy is the least productive and the least efficient? It's financial services. So it speaks very much to your point that the costs that are encountered by the end user are high, because the efficiency that exists within our sector is limited. It's a high-touch business. How do you get expert investment capability delivered to an end user who's not a big institution, he's not a government, he's not a sovereign wealth fund, but it's somebody who is concerned about their financial well-being and is planning sensibly for the future? That's the problem statement. The key to this is to make sure that we benefit from our scale. So what we've done, in answer to your question directly, what we've done in getting scale into these products is to, when we work with partners, we've negotiated not just on the back of the relationship that they're going to manage for us for your customers, but we manage that relationship in context of the entire position of them managing money on our balance sheet. So when they run $20 billion for us on our balance sheet, we get fee rates which nobody can dream of, not anywhere. And it's those same fee rates which we take then into the product. So the issue is the quality of what we're delivering, is it justified by the fees that we're then charging the customer? And we're very mindful of that, because if you've got a product which has an income target of, say, 5%, and the customer has to pay 2% to get in, and 1% a year on top of that, they may be getting their 5%, but they're giving up 60% of it in fees. So that doesn't work for us. And we would not offer a product like that, because we don't think that's good value for the customer. So when we sit down from a proposition point of view, I think you met Stu Spencer from Group and works very closely with the proposition team here locally. These are the questions they ask. and they sit on the other side of the table and they say, is this a good deal for your customer? I'm not sure all financial services companies operate that way, because that's not their job. Their job as a broker or as a relationship manager in a wealth management desk on a bank, their job is they are incentivized to create velocity, turnover. They're paid by fees going in and out. That's not how we're paid, and that's not how our fund managers are paid. We are paid by maintaining a strong relationship with you and your customer for an extended period. We are the only part of financial services that writes a long-term contract with our customer. When you go into a bank and you buy a mutual fund, the average holding period is 6 months. So of course they're incentivized to churn, to create activity. When you go to a broker, there's no contract to maintain the size of your account with that broker. It's a transaction, it's not a relationship. Very different for us. So when we think about stewardship and when we pull this together, people sort of say, oh Mark, anybody can do this. And in principle, anybody could do it. But let's look at the circumstances. Are you big enough to get the relationship with the different providers? Are you big enough to get the right fee? And do you have a long-term relationship with your customer? And ours is contractual. When we write a 10-year, a 20-year product, we're pretty confident that relationship is going to continue. So that means the way we charge fees over that period of time is it can be utilised and can be a benefit in terms of the economic arrangement, which no other financial services companies can't provide. So we don't get a transaction fee every time you change funds. That means we're not encouraged to change funds. It means we're encouraged to create a stable level of outcome over a long period of time. And our customer will pay us over a long period of time. So the economics are completely different. Now, it's not something you can explain to your customer in a simple way, but it's the relationship that's sitting behind what we do that drives our economics. We're not better people. We just have a different role, right? And our role is to maintain long-term relationships with our customers. So I think our commitment to you is to make sure that the products that we provide and that we introduce stack up, not just on an investment basis, but stack up for your customer after fees.
Waited for quite a while to hear my good news from our CEO to the doctor and to the student of life. Yeah. So, but anyway, there's a lot of protection to our customers. That's the reason why Princess, her team, JB has been working so hard to provide you all of these activities and products. Because as you all know, it is always a dream that all of us would be, all of the financial advisors would be very professional enough to understand and how we will be able to provide a total health and wealth portfolio. They understand protection and they understand savings. We have been doing a lot of sessions like this to make sure that all of you guys are prepared to provide total health and wealth solutions to our customers. Because I've been doing a lot of lectures. I created the presentation yesterday for you guys. Ladies and gentlemen, we will be launching in the future, very near future, the AIA Global Dynamic Income Paying Fund. The longest product name that I have created in my career. So, ladies and gentlemen, this fund is so very excited. Paano pa naman tayo? It's going to be the latest product that we have. This is leaning towards the mildly adventurous to adventurous investor. Right? Nandun siya sa ganong spectrum. No? This product will be able to provide additional income to our customer. Bakit mahaba po yung pangalan niya? Because that is the pitch already when you talk to your customers. Because number one, AIA, because we are AIA, we are stable as a company, right? We have the long history of Philem Life who understands the local market, but we have AIA who actually provides us our muscle in terms of the international scene or the regional scene. Correct? Yes. Item number one. Item number two, global. this product is being supported by no other than Mark. That's the reason why he's here. Basically, we are tapping into the skills of AIA, IM Singapore. So they
Very much. Well, for one, I'm going to be quick. I would like to keep you, no? Kasi meron pong pagkain doon. So yung mga nabitin, pwede ba? Okay. But anyways, it's actually a very interesting afternoon, no? You had a sneak peek of not only the upcoming product, but the man behind that product. So that gives us that confidence, no? That this has been thought of. And remember guys, the fund behind this is one of the best-selling funds in Singapore. We're using actually the same platform. So that's one. Another input is that I think they started first week of September and then they ended, kailan ba? September, kailan ba kami dumating from Step Up? Which is September what? 17, 18, okay. Can you imagine, in less than 18 days, yung ating kaibigan na Dilaw had a very similar offering.
Correct.
18 days ubos. Kasi this is, yun, naka-tranche. Ito, hindi ito naka-tranche.
this product is open-ended.
Open-ended. Okay, what am I saying? There is a demand. If you just know the right people for this product. Imagine, 18 days, ubos yung tranche na yun. It's not exactly the same, pero very similar. It's single pay, okay, payout, ganito rin eh. Okay? Pero yung sa, ano ba to? Open-ended, no?
This is open-ended, so basically you can make transactions on a regular basis.
Right. Yun, merong, mas parang IA ng konti yun. Kasi may end date. May end date. Ito, you can choose. Let's say after 5 years, okay yung performance, you want out, you can do that. 7 years, you can say 7. Okay? Anyway, the reason why I brought it up, because despite what we see in terms of the market, that's a testimony that there is a demand for it. It's not just for everybody. Meron lang siyang people who would understand. Gusto ko yung nilagay ni Ten eh. Mildly adventurous. Okay? You add that with what Mark Collins said. Anong sabi niya? Ang market nito, yung medyo